Target stock recently had a disastrous earnings report and the stock market reacted accordingly. Look right here, the company was trading at about $156 per share and it sold all the way down to around $121 per share. Now, this isn't the first time this has happened to Target stock, especially after an earnings report. If we look back in May of 2022, we can see right here, stock is trading close to around $220 per share, and in a single day, it dropped all the way down to around $161 per share after another bad earnings report. And look at this. This stock was once trading as high as around $260 per share in the summer of 2021, and it's now at $129.17 per share. So we have a lot to cover in today's video. We're going to be taking a deep dive into Target, looking closely at that valuation and some of the dividend metrics for this company. So let's go ahead and dig in. Now I want to take a closer look at the earnings report, but before we do that, I want to jump over to the dividend breakdown sheet and look at Target's dividend metrics. And you can see all this data is going to automatically load in thanks to the help of the ticker data add-on in Google Sheets. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. We're actually adding quite a few new sheets to the ticker data library this month, and you'll see one of them later in the video. Now, if we come down here, we can see after this huge sell-off, Target now has a starting dividend yield of 3.44%. So it's starting to get closer to that higher yield territory. That's a pretty nice starting dividend yield, especially when you look at the dividend growth history. Look at this 10-year dividend CAGR of 8.86%. The past 5 years, 11.3%. We can see there was a couple of huge dividend hikes from 2020 to 2021 and 2021 to 2022. Now, the most recent dividend hike was not a big one. It was actually pretty disappointing for most investors, and I think some people are concerned that dividend growth is going to start to slow down. Now, if we look at the payout ratio, free cash flow payout ratio, in 2023, Target used about 52 to 53% of its free cash flow to pay out dividends, which if we look at this historically speaking, that's a little bit above what they typically do. It's typically around 30 to 50%, but it's not necessarily a lot higher than what they typically see when it comes to free cash flow payout ratio. So for everything we see right here, the dividend metrics look pretty good for this company. This company is a dividend king, over 50 consecutive years of dividend increases. So we're off to a good start. Now let's start to dig into this earnings report and look at the reasons for the huge sell-off. Now to start off, we can see they missed on top and bottom lines. Q3 non-GAAP earnings per share came in at $1.85, which was a big miss by 45 cents. Now revenue was about $25.67 billion, up about 1.1% year over year, so pretty slow growth, but this was also a miss by $230 million. So we saw slow growth and big misses on top and bottom lines, but there's even more we need to start to break down here. If we start to look at things like traffic and growth, it's a little bit slower across the board with the exception of digital comparable sales. And this is one of the things the company tried to highlight. We can see here, strong digital performance. And if we scroll down, we can see they mention it again right here. But here's one of the things we have to understand. If we jump over to Seeking Alpha and look at digitally originated sales over the past few years, we can see it starts in Q2 of 2021. They saw decent growth for a little bit, but then they went 5 consecutive quarters with negative growth when it comes to digital sales. So yes, seeing double-digit growth when it comes to digital sales is a big deal, and it's worth highlighting, but we also have to point out, really all this is doing is getting them close to where they were before they had 5 quarters of negative growth. That combined with the fact that other areas are actually growing pretty slowly isn't necessarily a good sign for the company. So they missed on top and bottom lines, growth was a little bit slower, but what are they forecasting? What's the future guidance? That's usually a pretty big deal for a lot of investors, and understandably so. So before we look at what they recently gave us for guidance, I actually want to take a step back. Let's look at the previous quarter's guidance before we look at the most recent quarter. We can see right here, this is in Q2 of 2024. You can see right there, the company now expects full-year GAAP and adjusted earnings per share of $9 to $9.70, up from the prior range of $8.60 to $9.60. So last quarter, they actually increased the company's guidance, but let's see what happened in this most recent quarter. If we start to scroll down, we can see right here, they give us guidance, full-year expected GAAP and adjusted EPS range of $8.30 to $8.90. So after increasing guidance last quarter, they dramatically reduced it in this most recent earnings report. And there's no doubt this added on to the sell-off for this company. Let's continue to go through this to get the full picture. One of the other things that I want to point out is if we look right here, third quarter gross margin rate was down 0.2 percentage points from the prior year. But so far year to date, gross margin rate has expanded by a full percentage point compared to last year. So that's the bright side. So let's take a step back and talk about margins for a moment. We have to keep in mind what kind of business Target is. They're a retailer, and retailers typically don't have very high margins. So to start off, let's go ahead and jump over to the profitability sheet. Come up here and plug in TGT. Here's what we can see with Target. Looks like they had a pretty steady gross profit ratio for the majority of the past decade, and then in 2022, it tanked quite a bit, all the way down to around 24.64%, and if we look at 2023, they started to see a recovery around 27.63%, but they still can get back to that area of close to around 28 to 29% they were at before 2022. And like we just saw in that recent earnings report, they started to see a boost up from last year, so again, they're on that upward trend. This is one of the bright spots for the company. But while we're on the topic of margins, I want to jump over to a new spreadsheet that's getting ready to get added to tickerdata.com. Let's go ahead and come up here and plug in Target. Again, all this data will load in, and the main idea behind this sheet is to give us a complete picture of what's going on with the company's free cash flow. And this is one of the most important things we have to understand about a company. Over the long term, the share price of a company will grow if their free cash flow is growing. But at the moment, I want to talk about free cash flow in relation to the margin. So let's come down here and look at the profitability metrics in relation to free cash flow. And here's what I want to point out. The free cash flow margin for this company is sitting at 3.55%. Now, what is this telling us? Well, free cash flow margin is one of the best ways to look at a company's profitability because what it's doing is it's basically telling us how much cash a company is generating per dollar in sales. So for each dollar of revenue, how much of that is becoming free cash flow for the company? So for example, in the case of Target, free cash flow margin in 2023 was 3.55%. So for every $100 in revenue, this only added $3.55 to the company's free cash flow. Now, a low free cash flow margin for a retail company is actually pretty typical, but let's put this in perspective. What's the company's historical free cash flow margin been? If we come over here and look at a more in-depth guide on the free cash flow analysis, we can see our free cash flow margins over the past decade right here. Again, 2023, it's sitting at 3.55%, and 2022, one of the worst years for the company in the past few years, was 1.38%. But before that, it was quite a bit higher than it was in 22 and 23. Look at this, 2021. 4.8%, 2020, 8.4%, and it's pretty much higher every single year over the past decade than it was in 2022 and 2023. So even if the company was generating more in revenue, less of that revenue was becoming free cash flow on the bottom line. Now again, like we saw on the recent earnings report, the company did say that they're starting to see better margins, but again, gross profit margin still lower than it was over the past decade, not something I want to see. So we started to touch on the good and the bad for this company, so let's start to talk about catalysts for the company. Start to talk about the valuation for a moment. If we go ahead and jump over to the company and let's jump over and look at our stock screener. I've already plugged in Target right here, stock ticker TGT. Here's one of the things that's so impressive with the company right now. Look at the free cash flow yield for this company. It's sitting at 7.68%. That's a pretty high starting free cash flow yield. So for every $100 you invest in this company, they're going to generate $7.68 in free cash flow. That's typically considered a pretty good valuation. Also keep in mind, return on invested capital for this company has actually been pretty solid, especially for a retail stock. Over the past decade, not including 2013, return on invested capital has been above 10% every single year. Even during a bad year like 2022, it was sitting at 11.43%, and in the most recent year, around 16.17%. I think that's pretty solid ROIC for a company like Target. Now, if we go ahead and jump over to my stock valuation sheet, let's go ahead and come up here and plug in TGT. If we go ahead and jump over to our first valuation, we're going to be looking at Graham's valuation, which is a valuation model based on the expected earnings growth of the company. And it also takes into account some other variables which we need to point out. Now, based on their future guidance, they told us estimated earnings per share. Analysts gave us an average of about 8.38, and that was automatically imported with the ticker data function again, so pretty easy to pull in. But then we need to apply our growth rate projection, and this is where things get a little bit more difficult, but we do have some guidance again. We jump over to earnings on Seeking Alpha. Let's click on earnings estimates here and scroll down. We can see, obviously, we know the company is facing some headwinds, but after that, there's decent growth projected with the earnings. So again, I'm going to go close to what analysts are projecting, and we're plugging in 9 for our growth rate projection. So once we plugged all this into our formula, we have Y, which is the current yield on AAA corporate bonds. And I do want to touch on this for just a moment because it plays a major role in the valuation for this company. We can see the intrinsic value only comes to $118 per share, which is pretty low, even lower than the current trading price for this company. But I want to touch on the current yield of AAA corporate bonds. We can now see it's pretty much the highest that it's been over the past decade. It was pretty high as well back in 2011, early 2011. But for the most part over the past decade, it's been closer to around 3 or 3.5. And look at how much the valuation changes if it goes down to 3.5. I'll plug this in and we can see the intrinsic value jumps all the way up to $168.56. So again, this valuation model is very sensitive to economic conditions, one of the things we do have to keep in mind. So now if we go ahead and jump over to our discounted cash flow analysis, you can see in this scenario, you can see I'm projecting a growth rate of 7.5% to the future free cash flows of the company. Keep in mind, a company is always worth whatever their future free cash flows are. How much are they going to produce in future free cash flow? Tell me that, and I can tell you how much I'm willing to pay for the company. So once we do that, we find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents and subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of $156.17, which is actually about 21% higher than that current trading price for the company. If we jump over to our multiples valuation, this one's a little bit more difficult because, for example, Walmart, look at this. They're currently trading at a price to earnings multiple of 39. They've had a huge run up over the past year. If we jump over to Seeking Alpha and just look at Walmart stock, let's click on the summary. Look at this past year for Walmart, up around 83 to 84%. And most of that is going to be due to multiple expansion. Yes, earnings have grown just a little bit, but people are just willing to pay more for Walmart right now for whatever reason, but the same is definitely not true for Target stock and for these other retailers. So in this case, because this is a huge outlier, we're actually going to use the median price to earnings multiple. So if we take that median and apply it to Target, we still come to an intrinsic value that's higher than the current trading price, around $149 per share. Now, let's look at this historical multiple valuation. This is something I recently added to the stock valuation spreadsheet, and I'm going to be adding it to tickerdata.com pretty soon. Here's what we can see: how the company has been valued historically by the market. We can see the price to earnings ratio over the past decade for this company. Now, this is a case where we have to remember that valuation is an art, not a science. One of the things we can see is there's a huge data outlier again right here in 2014 with negative earnings per share, which will mess up our valuation. So what we're going to do is we're going to remove this to get a more accurate representation. Now what we can see is for the trailing 12 months, the price to earnings ratio for Target is sitting at about 13.64, while the average price to earnings ratio over the last 10 years is sitting at 16.78. That's a difference of around 19%. So Target is currently valued at 19% below what the market is typically willing to pay for them. That's a pretty interesting data point right there. Now, finally, if we jump over to our dividend discount model, basically what we're going to do is value the company based on how much they're paying out in dividends and how much that dividend is growing over time. So you can see here, we have a dividend growth rate of about 5.5% and a discount rate of 8.5%. With those variables, we come to an intrinsic value of about $156.14 per share. So if we jump over to our output tab, we have our 4 different valuation models right here. If we average them together, we come to an intrinsic value of about $144.87. So even when we apply the reduced guidance that the management team has been giving us, applied lower growth rates after hearing from analysts, we still come to an intrinsic value that's about 11% higher than the current trading price for this company. So with a 10% margin of safety, we can see the acceptable buy price for this company is around $130.38. If we apply a 20% margin of safety, it's closer to around $116. So it's not quite within the buy range with a 20% margin of safety, but at a 10%, it looks like it actually is. Along with this, we have seen that some analysts have been pointing out, it looks like there could be some bullish short-term catalysts for the company. For example, we're seeing record-breaking trends when it comes to holiday shopping, something Target is obviously primed to benefit from. And I'm starting to see other analysts point out that Target's starting to become an interesting risk/reward opportunity, and I think I do kind of agree. I think there's no doubt that there's better businesses out there than Target, but I do think the sell-off with Target has been a little extreme and probably overdone. So it'll be interesting to see what happens with the Target stock over the next few years, especially in relation to sales. This is what I'm going to be watching very closely. Can they get back to the growth that they were seeing pre-2022? If they can even come close to that, then I think Target presents a phenomenal opportunity. If not, you can probably still buy the company when it's undervalued right now, but over the long term, I don't think your results will be anything special. So go ahead and let me know what you think of Target stock in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.